Hi there. Good morning to all of you. On behalf of Informatics Ratings and indeed on my own behalf, it's my pleasant privilege to welcome you once again to our video analysis of a series on issues of considerable contemporary significance. We call this series Reading Between the Lines. We are today here to present to you an analysis of the RBI's monetary policy of June 2021. In this connection, let me highlight that prior to the policy, we had given you our take of the likely contours of the policy. More specifically, with macroeconomic situation, the RBI is likely to keep the repo rate unchanged and the accommodative stance would continue in all likelihood. It is gratifying to note that we were correct on both the counts. As expected by us and in fact by most market participants, the RBI kept the repo rate unchanged and also retained the accommodative stance of the monetary policy. To place matters in perspective, it's important to highlight that this was the 7th consecutive time when the RBI's MPC held the rates steady. The last time the RBI changed the repo rate was on May 22nd, 2020, when it reduced the repo rate from 4.4% to 4%. In terms of June 2020's one's policy stance, the repo rate remained unchanged at 3.35%. The marginal standing facility, MSF, and the bank rate also remained unchanged at 4.25%. The governor pointed out that the MPC was of the view that at this juncture, policy support from all sides is needed to regain the momentum of growth that was evident in the second half of 2020-21 and to nurture the recovery after it has taken root. To our mind, the case for a status quo monetary policy is stemmed from the compelling need for macroeconomic stability in the wake of widespread devastation caused to lives and livelihoods, continued uncertainty triggered by the second wave of COVID-19, decelerated economic growth prospects, and sticky inflation. In view of this macroeconomic landscape, the MPC sent out a loud and clear message. The message being to continue with the accommodative stance as long as needed to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. This suggests that though the rates at present are at historic low levels, further rate cuts down the road are not completely ruled out. Let us come to the issue of GDP growth. If we view things in a proper historical and comparative perspective, we find that pandemic-induced recession caused India's GDP to shrink by 7.3% in FY21, with Q4 growing by 1.6%, up from 0.5% in Q3 because of extensive lockdowns and stopped most economic activities. In this connection, it is important to recall that the Indian economy grew by 4% in FY20 and it shrank by 5.2% in FY 1979-80. In other words, this is the first macroeconomic contraction, macroeconomic shrinkage that we have in about 40 years or so. But what is of some concern to all of us is that extensive lockdowns and restrictions could act as headwinds to growth. Given the speed, scale, and severity of the second wave of COVID-19 infections, the RBI reduced the growth projection for this financial year from 10.5% to 9.5%. Now let us come to the issue of inflation. Retail inflation, which eased to a 3-month low of 4.29% in April from 5.52% in March, mainly on account of easing of prices of kitchen items like vegetables and cereals. There continue to be supply-demand imbalances on food items like pulses and edible oils. But it is expected that prices of cereals may soften with bumper food grains production in FY21. But the surge in wholesale inflation to 10.5% in April from 7.39% in March causes concern. The cognizable dilemma here is to check the inflationary spiral while shoring up a languishing growth in the aftermath of the rising dreaded coronavirus. While the evolving retail or the CPI inflation trajectory is likely to be subjected to both upside and downside pressures, the RBI's raising of the inflation forecast by 10 basis points to 5.1% is realistic because of widespread supply side disruptions. The RBI, in its assessment, has projected retail inflation at 5.2% in Q1, 5.4% in Q2, 4.7% in Q3 and 5.3% in Q4, with risks broadly balanced. Now, in case of liquidity and financial market guidance, it is welcome that the RBI has consistently attempted to create conducive financial conditions so that despite the devastating impact of COVID-19, financial markets and institutions keep functioning normally. Accordingly, adequate system-level liquidity has been ensured and targeted liquidity to stressed institutions and sectors has been provided. Hence, borrowing costs and spreads have reduced to historic lows. This has incentivized a record private borrowing through corporate bonds and debentures in financial year 2021. Reserve money grew by 12.4% year on year as on May 28, 2021, while money supply M3 grew by 9.9% year on year as on May 21, and bank credit grew by 6% year on year as on May 21. Another operation under GSAP of Rs 40,000 crore will be conducted on June 17, 2021. Of this amount, Rs 10,000 crore would constitute purchase of state development loans. Bond purchases have been raised by 20% to Rs 1.20 lakh crore to support the market. In case of surplus liquidity, we expect that possibly starting in Q4, October-December 2021, when the proportion of population vaccinated reaches a critical mass, the RBI may start lowering surplus liquidity, raising the reverse repo rate, and possibly also change its stance to neutral. Now, the issue of rate transmission by the banks has evoked considerable debates and discussions. An analysis of the successive rate cuts by the Reserve Bank of India reveals that transmission to banks' deposit and lending rates has improved significantly on the back of surplus liquidity conditions and the mandated external benchmark system of pricing of loans for a specified sector. Now, let us attempt to look at the crystal ball and try to visualize where do we go from here. In this connection, it is perhaps important to recapitulate that the RBI's annual report, which is placed in the public domain recently, stressed that the conduct of monetary policy would be guided by evolving macroeconomic conditions with a bias to remain supportive of growth till it gains traction on a durable basis while ensuring inflation remains within the target. We are happy to note that the RBI's June 2021 monetary policy is entirely in conformity with this stated policy objective. Now let us come to our concluding observations. The RBI is certainly conscious of the need of a multi-speed economic recovery. Contextual issues at the present juncture include well-calibrated economic policies and strategies to improve access to healthcare and education, support and retrain displaced workers, and strengthen public investment. There is a need to build more inclusive economies while ensuring macroeconomic stability, and the recent RBI's policy certainly takes some welcome steps in this direction. On the basis of an objective analysis of the macroeconomic landscape and emerging policy prescriptions, the RBI did well not to change the repo rate because of the evolving growth, inflation dynamics, and the heightened macroeconomic concerns caused by the second wave of COVID-19. In this connection, we must not be oblivious of the fact that the RBI has slashed the repo rate by cumulatively by 115 basis points since March 2020 to reduce the blow from the pandemic. Measures announced in this policy, such as on-tap liquidity window for contact-intensive sectors like hotels and transport, fresh liquidity facility of Rs 50,000 crore to NABARD, National Housing Bank, and Small Industry Development Bank of India, enhanced threshold limits are welcome and timely. Equally welcome is the enhanced coverage of borrowers under the one-time debt resolution framework by enhancing the maximum exposure limit from Rs 25 crore to Rs 50 crore for MSMEs, small businesses, and business loan to individuals. The governor's well-founded stress on ramping up, enhancing the vaccination drive, and bridging the gaps in healthcare infrastructure to mitigate the pandemic's devastation is fully justified and needs to be pursued with a sense of urgency. On the whole, we have no doubt that given the constraints of monetary policy, this is an excellent policy for the times. To discuss various aspects of this policy, We are delighted to have with us here a cross section of industry leaders. These industry leaders come from diverse streams such as academics, the banking and the financial sector. And I'm sure their views will help you to place things in a proper perspective to realize the implications of this policy in a more meaningful and effective manner. Thank you very much. Thank you for being with us here today. Thank you.
This is Professor Singh, Professor of Economics and Vice Chancellor Vivekananda Global University, Jaipur. My few observations about the RBI's Monetary Policy Committee recommendation for second bi-monthly review for financial year 2021. As expected, the bank maintained the status quo, keeping the policy stint rates at the fixed. Looking at the COVID situation, apart from policy rates, the central bank has also stepped up efforts to maintain adequate liquidity in the system, particularly the special liquidity window for contact-intensive sectors. However, the RBI has reduced the GDP forecast by 1% in this financial year, but commitment to the supporting of growth recovery is important. So it's shown the commitment for the growth recovery of economy in this fiscal year, and for this the bank has gone for the compromise in inflation also. If it raises to 20-30 points, it does not matter, because bank knows the immediate demand side pressure may not be the concern due to the pandemic issues. To my mind, all these measures together are likely to keep financial conditions in the economy benign and support recovery. Overall, the measures reinforce current accommodative policy of the RBI. So, to my mind, looking at the COVID situation and looking at the conditions of economy, the decision at the policy MPC is good, and I am sure these measures are going to increase growth in future. However, the future will be depending how COVID takes turns, whether it moves to rural areas or not. So that is the future question. For the time being, the policy decisions are certainly good. With this, thank you very much.
I am thankful to Infomerics Ratings and especially to Dr. Manoranjan Sharma for giving me this opportunity of putting forward my views on the recent monetary policy of RBI that was announced on 4th June 2021. As we all know, this policy was on expected lines. The Monetary Policy Committee maintained the status quo on key policy rates like repo rate and reverse repo rate. In fact, for more than a year, there has been no change in the repo rate, which has remained at 4%. But there are other measures that have been taken by the RBI in this context. The key takeaways, according to me, of this monetary policy are that although there has been no change in the key policy rates, the RBI has lowered its forecast for GDP and slightly raised the forecast for inflation. GDP forecast for 21-22 is now put at 9.5%. Earlier it was 10.5%, and inflation forecast is now put at 5.1%. Besides these, what I find in this monetary policy is that RBI is also trying, apart from augmenting the system liquidity, to distribute it more equitably. And in this context, we find that RBI has extended its earlier special liquidity window now to the contact-intensive economy sectors like tourism, hotels and restaurants, and further to provide more relief to MSME sectors. And for refinancing and lending, it has also provided rupees 15,000 crore to the SIDB. So these measures are aimed at alleviating the distress in the selected sectors. So therefore one can find in this monetary policy that although the repo rate has remained the same, RBI has always attempted to keep the liquidity levels high so that financial stability is maintained. The borrowing cost also remains low. One flip side of this keeping the interest rate low and the borrowing cost low has been that many corporate entities have changed their high cost debt by issuing new corporate bonds and debentures. They have taken advantage of the prevailing low rates of interest. So therefore one can see that the corporate sector also benefits from the augmented liquidity in the economy. If we look at the RBI's record of maintaining financial stability and adequate liquidity during the course of pandemic, we find that RBI has been able to satisfactorily discharge its stated functions. Inflation has remained within the limits of 6%, less than 6%, and at the same time RBI has been able to maintain the orderly changes in the economy. The one thing that we can find is that despite all the efforts, the credit offtake has not taken off in the manner in which one would have desired. The credit growth rate, according to the latest statistics, is only 6%. So that needs to be increased, although liquidity levels are quite high. The other factor that I would like to point out is that RBI has also provided a fiscal space to the government by transferring record surplus during the last 2 years. So therefore government has now fiscal space apart from its other sources of revenue to do more through the fiscal policy to lift the growth rate in the economy, to revive and survive and sustain the recovery that is underway. Hopefully the second wave is over by now. So therefore one can find that if the government also complements the monetary measures taken by the RBI, perhaps we would have better results. In fact, the monetary policy statement itself in a very polite manner reminds the government to rationalize the duties and taxes and cess on petroleum and diesel, and also it calls for that now we require the support of all sides, fiscal, monetary and sectoral, to increase the or accelerate the pace of the economy. Other factor that I find interesting in this policy is that our external stability has also been maintained by the foreign exchange operations of the RBI. There has been no volatile changes in the external value of the rupee. So that is a good thing for the exporters and the importers. But in future, I think the RBI will have to be watchful on inflation, because it itself says that inflation will remain elevated between 5 and 6%, although one would have liked it between 4 and 5%. The other thing that the RBI should watch out is that there is a need to keep the real interest rate positive. Higher inflation and lower interest rate will make the real rate of interest zero or negative. That will be a disincentive to the savers, because in the long term we require that the savings and investment rate in the economy goes up. I think overall I will say that the RBI has maintained a balanced approach in making its monetary policy, and hopefully RBI would be able to discharge its function well in future also. Thank you.
In view of the adverse economic impact due to the second wave of the COVID-19, resulting lockdowns, persisting uncertainties on the economic front, expectations of normal monsoon, adaptability of businesses to the new normal, that is working with the COVID pandemic, and need to maintain adequate liquidity, RBI has maintained a status quo on the rates and left them unchanged for the 6th consecutive time. The Reserve Bank of India has committed to continue with its accommodative stance until necessary to mitigate adverse impact of COVID-19. The spread of COVID-19 in rural areas and dent in demand in urban areas pose downside risks to growth. The RBI has lowered its estimates for economic growth to 9.5% for FY 21-22 as against the earlier projected 10.5%. Though the outlook is uncertain, the retail inflation is likely to be 5.1% during the year. In view of the expected normal monsoon and resilience of farm and business economy, the central bank has tried to balance growth, which is of paramount importance, while attempting to maintain low inflation. On the forex front, the exchange rate is stable and the forex reserves have risen to something like $600 billion. The Central Bank, has also announced that it would buy Rs 40,000 crore of government securities in June as part of the government securities acquisition program. Additionally, the GSAP 2.0 of Rs 1.2 lakh crore will be conducted in Q2 of FY22. This is expected to aid a stable and orderly evolution of the yield curve amid comfortable liquidity conditions. The same is also in line with repeated assurances of the RBI to ensure adequate liquidity in the financial system to help productive sectors of the economy as well as the government's increasing borrowing program. The RBI has announced several additional measures to help ailing businesses. It announced a big relief to contact intensive sectors like the hotels, restaurants, tourism, travel operators and saloons, etc., which have been impacted adversely on account of the COVID-19. The scheme, which has been announced, is by way of an on-tap separate liquidity window of Rs 15,000 crore at the Repo rate. Under the scheme, the banks can extend fresh funding support to such sectors till March 31, 2022 with tenors up to 3 years. In order to further incentivize the banks to lend under this scheme, the banks would be permitted to park their surplus liquidity up to the size of this freshly created loan book with the Reserve Bank of India under the reverse repo window at a rate which is 40 basis points higher than the reverse repo rate. A special liquidity facility of Rs 16,000 crore has also been extended to Small Industry Development Bank of India, that is SIDBI, at repo rate, so that it can support higher number of MSMEs. All borrowers to Rs 50 crore can now be covered under the RBI's Resolution Framework 2.0. This would effectively mean that over 90% of the borrowers in the banking system in the country are eligible to be covered under the Resolution Framework 2.0 of the RBI. I feel that the proactive and preemptive measures announced by the Reserve Bank of India are in the right direction, are expected to facilitate a durable recovery with relief to contact intensive sectors, the resolution of stressed assets of borrowers up to Rs 50 crore and equitable distribution of adequate liquidity support. Thank you.